Investing studies have shown that investors that buy and hold far outperform those that try and time the market on a consistent basis. I often say I prefer time in the market over trying to time the market. Here's a look back at a study that was done from 2001 through 2020. In that time span, the S&P 500 climbed nearly 320%. Remember, that period included the huge fall in 2020 from the global pandemic. When fear levels were running high, the S&P 500 still eked out an 18% gain after falling 30% at one point. Had someone sold near the bottom as the markets continued to crater day in and day out, they would have potentially missed out on the V-bottom reversal higher as the S&P 500 climbed 70% in a 9-month time span. A recent study conducted by the research firm Dalbar details a 20-year history in the stock market from December 1999 through December 2019 prior to the pandemic, which also includes 2 bear markets. During that time, the S&P 500 averaged annual gains of 6.06% during that time span. However, the average investor realized gains of 4.25%, underperforming the S&P 500. Less than 2% difference may not seem like a lot at first, but as your portfolio balance grows, it can have a huge impact. Starting with a $500,000 portfolio at age 45, this emotion-led gap in returns year after year would compound to an account value of $1.1 million instead of $1.5 million, which is a shortfall of $400,000. Now let's look at another study that was conducted by Charles Schwab, even more concerning when you are thinking about trying to time the market as well. During that 20-year period from 2001 through 2020, so including the pandemic this time, the S&P 500 returned 7.5% per year on average. If you missed the 10 best days as you were trying to time the market and you weren't invested at that time, if you missed the 10 best days, your returns were sliced by more than half to 3.4%. If you missed the 20 best days, your gains were essentially even. And if you missed any more than 20 days, you actually saw negative returns over that time span. This chart here from Charles Schwab shows that if you started with that same $500,000 portfolio, it would have increased to nearly $2 million during that time span just in the S&P 500, or just with those average returns. However, if you missed just the top 10 best days, the value of your portfolio would be $1.09 million. Still meaningful money, but nearly $900,000 short of just the average S&P 500 returns. With all of that being said, it is important to always have your money working for you in one way or another. And in today's video, we are going to look at 2 dividend stocks to buy and hold for the next decade plus. But before we begin, do me a huge favor, as it really helps me with the algorithm, and click that like button down below and subscribe to the channel, as I greatly appreciate it. And let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your due diligence before investing in any stock. And before we begin, let me take a quick moment to thank today's sponsor, which is The Motley Fool. The Motley Fool has a ton of great products and tools for investors looking to research stocks, and they also have products such as their 10 best stocks to buy right now, which you can see that list by going to fool.com/Mark, type in your email, and you'll get that sent right to your inbox. So now let's jump in and look at 2 premier dividend stocks to buy and hold for the next decade plus. Decade dividend stock number 1 is Microsoft Corporation, stock ticker MSFT. Microsoft Corporation is a massive technology company with a diversified portfolio, and they currently have a market cap of $2.38 trillion, making them one of the largest companies in the world. Over the past 12 months, shares of Microsoft have climbed 22%. And year to date, get this, shares of Microsoft are up over 30%. Microsoft has been on fire in 2023, and a lot of that has to do with the AI craze that is going on throughout the market. Microsoft has ChatGPT, which is owned by OpenAI. They are invested in that company, which is the leader so far in AI, which is a very strong and fierce race that's going on. It seems like everyone is racing to get to the top of this AI craze, from companies such as Nvidia, from Meta Platforms, Alphabet with their Google and their AI platform is called Bard, and even Tesla is getting involved in this AI craze, and many more. But the great thing about Microsoft, although they have this AI growth potential moving forward, is they are much more than that. They are very diversified. They have their Windows operating system. They have their Microsoft Office suite, which includes things like Microsoft Excel, Microsoft Word, PowerPoint, and many other things. They also have gaming with Xbox, and we've seen the stuff going on with Activision. And they are a major player in cloud with Azure. And the thing about AI is when you have more AI, you have a need and a growing future demand for cloud. When it comes to dividends, you do not generally invest in Microsoft just for the dividend alone, because they have generally paid a very low dividend yield. But part of that is due to the outperformance in the stock. Over the past decade, shares of Microsoft have climbed over 800%. So irregardless of how fast you're growing your dividend, because if you recall, a dividend yield is based on the dividend rate and the stock price. If you continue to grow that dividend rate, but the stock price is growing so much faster, your dividend yield is actually going to go down. And that's exactly the case here with Microsoft. Microsoft currently yields a dividend of less than 1%, but they have a 5-year dividend growth rate of 10%, which is what I like to see. In addition, management has increased the dividend for 18 consecutive years and counting, nearing that 25-year mark to become a dividend aristocrat. The dividend is also very safe with a low payout ratio below 30%. Now for valuation, and let me start by saying Microsoft is not a cheap stock by any means, but the cloud and AI potential is huge, even gaming, so you are naturally going to pay up for that growth. Analysts are calling for EPS of $11.06 a year from now, which equates to a PE multiple of 29 times, nearly double that of the S&P 500 average, which is usually between 15 and 16 times. Over the past 5 years, Microsoft shares have traded closer to an average multiple of 30 times, and over the past decade, closer to 24 times. So that 25 to 27 range is an area where I would like to add more Microsoft. But it's really going to come down to your portfolio. For me, I already own a nice chunk of Microsoft, so I'm not jumping to add more Microsoft at this very time. But if I see that multiple come down, then I will definitely put even more money to work in Microsoft. But I love that 10% dividend increase that you're getting, making them right on the cusp of a dividend growth stock. Now for our second decade dividend stock, which is the Home Depot, stock ticker HD. Home Depot is the premier leader in the home improvement sector, and they operate within a duopoly with Lowe's companies. Home Depot currently has a market cap of $295 billion, so Microsoft was trillion, Home Depot is in the billions, and over the past 12 months, shares of HD are up 3%, but year to date they are down 6%. Home Depot is often connected with the housing sector, and housing has been under pressure for much of the past year due to the increase in interest rates. However, in recent weeks, we have seen some improving housing data, with some economists starting to call a bottom in the housing sector. However, it appears that we are nearing the end of this rate hike cycle, so that housing bottom call could be justified. Both Lowe's and Home Depot recently reported their quarterly earnings, and for HD, it showed the worst revenue miss in nearly 2 decades. Q1 did see some weather delays, especially in California, which they have great exposure to, which saw a ton of rain by California standards, and management expects a slight decline in sales for the year now after initially looking for flat sales growth. So the near-term pressures are there, but for long-term investors, this is creating an opportunity in a great company. Right now, you're getting shares of Home Depot with a dividend yield that is nearing 3%, not something you see all that often with Home Depot. As we looked at with Microsoft is increasing their dividend at a 10% clip. However, the dividend yield is going down due to the outperformance by shares of Microsoft. However, Home Depot has been on the flip side as shares have been flat to lower here year to date. However, they continue to increase their dividend at a strong clip, much stronger than that of Microsoft. But remember, it's a calculation. If the stock price goes down and the dividend rate goes up, your yield is naturally going to go higher. Home Depot currently yields a dividend of 2.9%, which is well covered by a low payout ratio, and they have a 5-year dividend growth rate of 16%. The company's management has increased the dividend for 13 consecutive years and counting. Now we're going to take a look at valuation, which is going to paint a very different picture than that of Microsoft. Microsoft is a much faster growing company, but Home Depot shares have been under pressure and the shares right now look quite intriguing. Analysts are calling for a dip of 10% in earnings per share this year, looking for EPS of $15.02 per share, but then they call for a rebound of 7% the following year. This equates to a forward price to earnings multiple of 19.4 times, and even with the lower EPS. Looking ahead to 2024, the earnings multiple is even lower at 18.1 times as they are expecting that 7% rebound. Over the past 5 years, for comparable purposes, Home Depot shares have traded at an average multiple of 22 times, which is about the same that they've traded over the past decade as well. Analysts have a moderate buy rating on shares of Home Depot with an average 12-month price target of $333, which is a 13% increase from today's prices. So there we have it, folks. We just looked at 2 premier dividend stocks to buy and hold for the next decade plus. Microsoft is going to be that higher growth company, lower yield, but still increasing their dividend at a rate of 10% plus per year. And then you have Home Depot, which is one of the gold standards here in the US. As the US economy and the housing sector continues to climb back, Home Depot will benefit from that. So right now they're going through a slow time, but that might be the time to jump into shares of Home Depot, especially if you are a long-term investor. Down in the comments section below, let me know which of these 2 stocks would you buy and hold for the next decade. And if you haven't done so yet, smash that like button and we'll see you in the next video. Take care.